Alright folks, trading smart money correlation concepts. Alright, one of the strongest concepts I have as a trader is the use of correlation. Alright, a lot of traders in the realm of analysis, you can go either way with this. There's a lot of people that have a lot of faith in correlation, and there are others that simply want to assume that there's no such thing as correlation and it can't be relied upon because it isn't consistent. Well, they're both right, and in between lies the truth. Correlation works all the time, and correlation sometimes breaks and cracks. And when it breaks and when there's a crack in that correlation, there's like a ripple that goes through the marketplace. Okay, and who do you think causes that ripple? There's a slight tear in market symmetry. Within that tear or ripple or break in correlation, that's the footprint or fingerprint that's left by the smart money. My analysis has always been focused on finding the cracks in the market, albeit briefly. The smart money's actions get revealed during this time. I commonly refer to it as a smart money fingerprint. They leave it in the charts as they switch the tide of the current intermediate term price swing. Intermediate term swing points are where the real potential resides, not minor price swings. Alright, we're going to discuss the US dollar index smart money tool. Okay, much like trading stocks, it would be foolish not to consult the major market averages to determine the current market tone. So the same thing holds true for trading currencies, and the US dollar index is our reference point. If we see the US dollar rising, this translates into bearish foreign currency prices. Conversely, if we see the US dollar falling, this translates into bullish foreign currency prices. Now, by itself, that's rather simplistic. But if there's a time in price study that you notice that the dollar index fails to go higher, okay, and your foreign currencies fail to make lower lows, that's a crack in correlation. Because as the US dollar goes up, foreign currencies should be going down. If a foreign currency fails to go lower, making new lows, while the US dollar makes higher highs, that is a major fingerprint left by the smart money. That's when they are distributing and accumulating. Okay, let's look at a little greater detail. All right, here we have the US dollar index, going to be represented by the black line at the top here. And we're going to look at, we'll just use this green line as an example. Say it's the British pound USD or cable pair in the Forex market. Okay, price would be meandering around. The dollar would be trading down as the British pound is trading higher. Price makes a intermediate term or short term low in the marketplace on the US dollar index. At the same time, inverted correlated pair cable, which would be pound USD, it would be making a short-term or intermediate term high as noted here. And price trades down in the cable as the dollar rallies up a little. At some point, that low in the US dollar will be taken out. As price trades lower on the USDX, the cable, notice what has happened here. There's been a failure to make a higher high. Higher highs and higher lows, lower lows in the USDX versus higher highs in the cable. In other words, as the USDX makes lower lows for perfect market symmetry, there should be higher highs made in the cable or whatever currency pair you're trading in the Forex market, because there's an inverse correlation. Okay. Well, this right here is what I refer to as a USDX SMT divergence. Okay, US dollar index smart money tool divergence. This is like a crack in market symmetry. There's no longer a correlation. There's a break in it. So there's a tug of war between what's going to take place. Is the dollar going to continue to go lower, or is the cable going to continue to go higher? And that tug of war We don't need to know who's going to win that. Okay, we just look for that crack. So if we see this, okay, we are tipped off that there's a footprint now left on the market, and the fingerprint of the smart money is laying right there on the chart. And then we can do a whole lot with this, but let's build on it a little bit further. Eventually, when you see that crack or divergence, the dollar index will go northward and the foreign currency pairs will go lower. Okay, so now you know how to discern intermediate term price swings in the market. Now this can be reversed also. The uh, the green chart here could be representing the U.S. dollar. I'm sorry, the cable, and the U.S. dollar could be represented by the black lower line. Okay, and as the U.S. dollar, okay, fails to make higher highs when the cable makes lower lows, okay, that is also a USDX SMT divergence, okay, because there's a crack in the correlation. Just like the major market averages should confirm themselves with trading stocks, well, we want to be seeing the highs confirmed with lower lows in the cable. In other words, if we have higher highs in the USDX, there must be lower lows in foreign currencies. If that fails to happen, you are seeing the actual accumulation and or distribution phase happening real time on your chart. So now you have an x-ray view of what's actually happening and prepare yourself to get in sync with that major tide change. If you see this scenario here, the green line representing the cable, this would be an indication to look for long or buy signals in the foreign currency market and especially on the cable. Even though it just dipped down below that previous low, that's how I get in there and buy up stop rates, because I'm using this concept to tip me off to it's a suspect decline. It's only going down to take out the stops. I see that because the dollar index failed to make higher highs. This decline is a sucker play. Okay, think like the Judas. Okay, this is also one way you can confirm Judas swings. So now you have a well-rounded concept of looking with quote unquote an x-ray view of what's going on in the price charts. Most of you have already seen this concept. It's been out for well over a year and a half now. I've revealed the SMT divergence looking at correlated pairs. Okay, and the top line, the black line, let's use this as the fiber or EUR/USD pair, and the lower line, the red, would represent the cable British pound USD pair. At some point during market trading, if you are anticipating a support level to be traded to, and if the fiber fails to make a lower low into that higher time frame support level, while the cable does succeed in making a lower low, okay, that is an SMT bullish divergence. Look for both of those pairs because they're closely correlated. Look for both of them to trade higher, and that's represented by this divergence. Okay, this is all you're doing is referring to price lows. Okay, just pull up any time frame, and the more significant price swings will occur on 15-minute and up. Okay, but you can obviously day trade and scalp using 5-minute charts if you very versed with key support and resistance levels. But this divergence will form at a predetermined key support level, and that could be in the form of a previous day's high or low, a pivot level, it could be a Fibonacci, it could be the matrix levels on the Trinity. Okay, anything that would be versed as a support level, okay, or a resistance broken then traded back down to as support, you're looking for this pattern to unfold to confirm your underlying premise that the market should rally. Okay, you're not looking every day just for this to occur, just to take a trade. You should already have a predetermined support level in mind when looking for this. When this pattern unfolds, that's your green light. Go get in there and take your entry signals. Okay, much like a lot of my things that I share, all you have to do is invert the explanation and you get the the sell side of it. We're going to use the top red level, red line. That's going to represent the fiber, EUR/USD. and the black will represent the cable, British pound USD pair. At some point, if you're expecting a resistance level to come into effect on a higher time frame, that would be weekly, monthly, daily, 4 hour, 1 hour. Okay, if you're looking at a key resistance level that would be possibly a deterrent for higher prices and you're looking for sell signals, if you see the fiber make higher highs while the cable fails to make a higher high and diverges, it, it's not dependent upon on which one of these pairs is actually making the higher higher, lower low. Okay, it just means you're looking at both pairs, and if one fails to do it, that's the crack in the correlation. That's when the smart money's moving in the marketplace. As you can see, if we're using the black line to represent the cable, they're going to be selling a whole lot of cable, okay, into those highs. Now, there doesn't mean they're not selling into those highs in the fiber. It just means that there's a whole lot of selling going on in the cable, and because the smart money trades in such a large volume, they leave a huge footprint that they can't hide. They cannot hide it because their flows are so large. It will cause this disparity always at significant intermediate term or long term highs. Okay, and that would be in the form of this divergence. One pair making a higher high while the other pair that's closely correlated fails to make a higher high. That is a correlated pair SMT divergence. When you see this unfold at a key resistance level that's already predetermined on your chart, and it's the time of day when you would expect a signal to unfold, kill zone, we can get in there and take our short sells. It confirms our predetermined bias for the move or day's trend. Okay, folks, we're going to look at an example of how we can use the concepts and ideas that were discussed on the earlier slides. And what we're looking at is the United States dollar index on the upper chart, and the lower chart is the cable British pound USD pair. And we have our charts chained on the first week of October of 2011. Okay, what I want you to note is there is a rally underway. Okay, this is a 1 hour chart on the dollar index and cable. Okay, price was rallying up here. All right, and then we made a intermediate term high in the marketplace. Notice at the same time there is an inverse correlation between the US dollar and the British pound, and you can see that unfolding here. But now here's what I want to tip off to you. There's going to be a crack at some point when there's a major turn in the marketplace. All right. Now, a major turn to me is 150 to 500 pips. Okay, that to me is something that is significant. That could be argued with other traders, but for me, because I am a swing trader, short-term trader by nature, that to me is a significant price change. Okay, so I'll leave that up to you to argue about whether or not it's significant or not. But for me, this is how I call intermediate term highs and lows in the marketplace before it's obvious in the chart and everybody's saying, wow, I wish I could have shorted back there or bought at that low. Notice the high here. It's directly diametrically opposed to the low formed in here. Okay? Do you see the crack? Notice how the dollar index failed to make a higher high while the cable made a lower low. There's your USDX SMT divergence. This right here, if you see that crack in correlation, that means that there is a reversal, okay, of some significant magnitude about to take place. The dollar failed to go higher, okay, while the cable made a lower low. There's a crack in correlation, expected change in tide or swing. In this case, expect a move up while the dollar drops lower. Okay, there's your example of a USDX SMT divergence indicating a high in the dollar and low in the foreign currency market. Now, that's kind of cool, but how can we see a intermediate term high in the cable and intermediate term low in the dollar? Well, it just so happens that this chart's trained in an area where you can see that. Notice that the dollar was unable to make lower lows right here. At the same time, the cable was able to make a higher high here. Now granted, we went into consolidation here, but notice that the cable eventually traded off as the dollar traded higher. Okay, we have our charts trained in on the first week of October, and here is the October setup with a 15-minute chart. And we're going to be able to combine all those things that we saw just a few minutes ago. Notice how we have the cable, okay, was trading in that day. We had the Asian range, price dips out of the Asian range, chips everyone fake short, chips all the short sellers in, runs up above the Asian high, okay, runs the stops above these highs over here, gets everyone set up to think it's going to go higher, and they slam it down. It drops lower into, okay, an old low, taking out the stops here. But notice what happened. We made that lower low. Okay, see how we have that lower low here? Let's look at what that looks like combining the correlated SMT divergence. Okay, we have, just get my charts lined up here. Okay, here we have the cable. This is that drop down in price we just looked at, taking out that old low. Notice it was significant enough to sweep underneath this low as well. That's right here. This right here is a Judas swing. How do we confirm the Judas swing? Is we go back to what we referred, the dollar index was failing to make a higher high right here. At the same time, the cable made lower lows. Now you have a greater chance of this being a profitable setup, okay, if you see the correlated SMT divergence, and that's the fiber down here. So notice how the fiber was unable to make a lower low, okay? That's your SMT divergence we've been talking about for over a year and a half now. This is the indication, okay, that there's a crack in the correlation between these two pairs at a time when the USDX is also signaling a major intermediate term tide change, okay? And then by doing that, you can get yourself in sync with buying, okay, and then looking for buy signals until we get a converse USDX SMT divergence and or a considerable correlated SMT divergence between cable and fiber or any closely correlated pair. And that is seen by this example. We have higher highs made in the cable, okay, and lower highs on the fiber. Okay, and go back to our example on the USDX pair, and you see that there was the crack in correlation between the US dollar index and the cable, and that nailed the high here. So we were able to see with the x-ray view, quote unquote, the low as it formed and identify it, and the intermediate term high as it formed. And granted, we went in the consolidation, but we did trade off several hundred pips in the cable, and again several hundred pips, almost, well, actually over 1,000 pips on the euro. Okay, so hopefully you guys can grasp this concept. Watch this video a few times, and then grab your chart books and go through and see some examples and take some notes on major significant highs and lows in the marketplace, and you can really narrow down some stunning accuracy with calling highs and lows, or quote unquote market tops and bottoms. Alright, folks, you're going to have to learn how to anticipate cracks. As a trader, we want to be looking for significant price swings to profit from. When we learn to study price action near key support and resistance levels on higher time frames, we can anticipate the actions of the smart money. When the USDX, US dollar index, and correlated pair SMT divergence materializes at a discernible and predetermined support level, we can have confidence that a reaction will unfold, a bounce or rally higher up. The reverse holds true for key resistance levels. Okay, smart money moves large flows, and by that very fact, their movements leave huge footprints. It cannot be hidden from informed traders. So it's with great pleasure that I welcome you to the inner circle of price action theory.